And hey guys, Michael, Tomek, and Raf, good to see you all.
Hi there.
So look, I'll maybe just mention where you guys are from, and then I'll give you a chance to do an introduction of yourselves and your companies, if that's okay. I think Raf is still connecting. I had a few issues before, so maybe he's having some as well. But anyway, so Tomek is one of the founders of a company that we've invested in, of Omnipack. It's great to see you. Michael is one of the founders and partner at Speedinvest. And Raf, when he joins, hopefully he'll join shortly, is a partner at Kondracki Celej, and I hope I got that right. Mikhail from my team was going to correct me if okay, Tomek?
That was good. That was good.
Celej? Okay, which is a law firm in that we work with quite closely in Poland.
Hi everyone, can
Hey,
you
Raf.
hear me and see me? Yeah, sorry.
Yeah,
Technical
I
issues
did a very
always.
quick intro whilst you were gone, taking advantage of my poor Polish pronunciation to
No, that
introduce.
was perfect. I actually heard everything, so that's
Okay.
perfect. And everything's correct.
So maybe I'll give you guys, just a couple of minutes to say a few words about yourselves before we kick off. Tomek, let's just go kind of in this direction as I see it. So Tomek, then Raf, and then Michael.
Right. So hi everyone. I'm founder and CEO of Omnipack. We enable D2C brands to grow by providing frictionless fulfillment. So in simple terms, we take care of storing and shipping products globally so that our merchants can focus on core of their business, be it product, sales, marketing. We take care of all the difficult and dirty physical stuff.
Awesome.
Michael?
Raf? Or Michael? Let's do Michael next. Yep.
Perfect. Hi, I'm Michael from Speedinvest. Co-founded this venture fund 11 years ago. We invest across Europe in all kinds of models, and we're close to 300 portfolio companies, out of which I would say, best estimate, a quarter of them has used venture debt at some point in their lifetime, and a bunch of them is also in CEE in all the countries, I guess, or almost all the countries. So I hope I can contribute something here.
Sounds great. Raf?
Hi again. I'm a partner at a Warsaw-based boutique law firm that specializes in advising tech companies and venture capital funds and investors in venture capital transactions and tech M&A deals. And we are one of the most active legal advisors in CEE in terms of venture capital transactions.
Okay, well, thanks very much, guys. I think before we kick off, it'd be good to just remind people in a couple of words what venture debt is. Maybe not everybody is as familiar with it as we all are. But effectively, and I'll have a go. If you guys think I'm getting it wrong, let me know. But effectively, venture debt is a loan to a company that complements its equity round. So, for example, if a company wants to raise 10 million in equity, it can raise 3 of that 10 in venture debt, which is non-dilutive. It extends basically its runway to the next valuation point. So it benefits founders and angels and early investors through reducing dilution and effectively optimizing the company's capital structure as soon as it's able to do so. It's not, we often sort of say, you're convertible. We're not a convertible. So venture debt is not a convertible instrument. It doesn't convert into equity. It usually has a warrant, which is a little bit of equity participation, but it's not a convertible. And it's also not a bridge loan. So also at times we get questions from companies that need to get through the next 3 months. They've run out of cash. And they're looking for a loan to get them through the next 3 months. And we always say, well, that's really the equity's job to do that. We'll come in alongside once you do that. So that's a, I don't really want to spend too much time going into details, but effectively that to me is what venture debt is and what it's for. And because it's sort of linked closely into an equity raise or equity rounds, I think if we think about why venture debt is or isn't as well represented as it could be, a good place to start maybe where the venture capital ecosystem is. And I know we've covered this a bit in this conference already, but maybe from your guys' perspective in CEE or in your regions, in your perception, kind of what's been the development in the venture capital space in the region for the last 12, 24 months? Who wants to go first? Maybe Raf, start with you from the legal perspective. You see everything, right?
So yes, it's true. We work with founders, with investors, institutional and angel investors. So we have a broad overview on the CEE market in particular, obviously Poland, where we're based. So from our perspective, the biggest change in the past, I would say 12, 24 months, is the volume and value of VC rounds and general financing rounds in CEE, but obviously in particular in Poland. And especially 2020 and 2021, we've seen a tremendous growth. In 2020, Poland reached almost $500 million of invested funds in startups. 2021 around 850, and already in Q1 to this year we have 250 million. So we are getting there in terms of keeping the pace with volume and value of deals. There's hundreds and thousands of deals happening in Poland. So I would say that the last 2 years were crucial in terms of that, and also from a kind of perspective of growth rounds. We see more and more Series A, Series B, even Series C in Poland, which is not only seed, because in the past years there were a lot of venture funds with seed money, but not that many with growth money. So this has been a significant change.
Yeah, I think Poland's been quite impressive actually, and that's a very good perspective. But maybe Michael, you've got a broader kind of CE perspective because you look across the region. How do you see this developing, and what have you seen in the last couple of years?
Well, I was actually happy for Raf to start, because it's always weird if a venture capitalist comments on the state of venture capital. Yeah. Right? It's like a car salesman talking how great. But yes, I think you have to say over the past 24 months, the ecosystem has come of age. Maybe we'll see in the next 24 months, but has definitely made a big step forward. And I think we'll look at that development in the future and say that this was the start of a lot of great companies. There has been an influx of funding that we haven't seen before ever. It will be a year, like especially last year, will be for the history book. Let's see how this year is. The early numbers, we know that they're good, and I think sort of also not only on the funding side but also on the entrepreneur side. I think looking at the last 10 years in this industry, it's really wonderful to see how much founders have matured, how more ambitious they become, how much more international they've become. So I think we've caught up in many ways to peers in other regions, which is good.
Sounds great. And Tomek, anything to add from a founder's perspective?
I would pretty much complement what the guys said. So pretty much really positive 1-2 years. Market is getting much more professional, more international VCs feeling comfortable in the region, and then really local VCs stepping up their game. So both in terms of really investing and building the ecosystem, networking opportunities, but also the mindset, really close the deal, use a neat term sheet process, and then deal closing. So really beneficial for the local founders.
Yeah, and that's music to the ears of venture debt. I think the deeper the market, the kind of the more opportunity there is for us, and the more accepted our product is. And maybe that's the next kind of question that I wanted to ask you guys is, we still, I suppose, over the last few years, we have to explain still what venture debt is, and the perception varies across people. So what, and if we think about kind of what why venture debt may be underrepresented, if that's the case, maybe perception is one thing. So in your, maybe Tomek, starting with you this time, what's kind of, how do you, is there a perception issue? How do people perceive venture debt in the region?
I mean, I think it's a process. It's an educational process that just needs to take place, and it's probably going to take some time. So I remember my first conversations with a venture debt fund was 2 years ago, and back then it was really sort of just learning from learning the basics on how it works and just trying to figure, browsing on the internet, what are the standards. And pretty much nobody I reached out to in Poland knew anything about that. And I think that has changed quite visibly, but we're still, I think, scratching the surface, right? So when we announced a round with you guys, with you participating, actually quite a few founders reached out to me to learn a bit more. So the interest is there, and many founders are looking into it. But I still think it's early innings, right? So it's more for those, I would say, financially savvy entrepreneurs who are looking for ways to optimize, because that's not the sort of standard traditional way. And I think it's just going to take time. So I've seen the progress over the last 2 years. I think in the next 2-3 years, that's going to improve even more. And a lot of work that needs to be done is on the education.
Michael, what do you think? You said only 25% of your companies have done venture debt. Doesn't sound like it's high enough. What do you think?
I mean, I guess you would want to hear 100%, but then I think
I realize it's not always sort of, it doesn't always fit the bill. But we're curious to see your because you from a VC perspective, you probably, I'm sure, you know all about venture debt, but you interact with a lot of founders. Kind of how do people think about this?
I mean, there's a particular set of challenges also in many geographies, and maybe Raf can shed some light on this. But CEE, also we're talking about CEE, it's not a region, it's not a thing. Like every country has its own legal frameworks to things. Some are tougher on the warrant side, others have an issue with sort of how the balance sheet then looks after taking on a lot of debt. And there's a couple of things to overcome. I think that over time will solve itself, and maybe we'll also change some legislation around it. But that is definitely a set of challenges for startups. But I'd like to highlight another part that I've noticed in the discussions with founders, and maybe Tomek, I'd also be curious about your opinion. I think there's still some hesitance in CEE to take on debt to finance a company, and it's, even though you're adding venture in front of the debt, what founders hear and read is, okay, I'm taking on debt. What does that mean in terms of personal liability? Will you guys come after my house in the end? What does that mean for my business? And there's certainly a lot of education and also change in mindset necessary. And it doesn't, I mean, we've been telling this to our founders for the past 10 years that sort of the best companies in the world at some point in their stage have taken on venture debt. There's, from Google to Facebook to everyone, there's all these stories how this works. But then, of course, there are also situations that I as an investor see where venture debt providers come onto a board as an observer and don't really act like the venture part. They act more like the debt part, right? So there is some I think there's some learnings on both sides that need to happen in order to accept this as a part of the financing mix. A very useful part that you just need to know when to use and how to use it best. But if it fits, it's actually a great addition.
No, I mean, absolutely. I think this really plays to the education part, right? So the word debt implies that it needs to be repaid. So that I imagine might just make some founders a bit uncomfortable, because it's just a different instrument, right? And then given the market is not that mature, it's not clear to most of the founders, okay, so how fast do I have to repay it? If there is any grace period, meaning only interest period. So there is not much knowledge in that. So sort of the first reaction is probably a bit skeptical because of that. So I think once there are more cases of companies that use venture debt and then have been using that for a couple of years, and they're success cases, meaning where they actually help them to even further accelerate growth and then raise next equity round that then they use to pay off the debt, then I think that, everybody's going to be much more comfortable with that.
And I think for everyone's benefit, Tomek has still got his house, so we're not planning to take that away. But in all seriousness, I think it's generally, as we approach venture debt in any case, we certainly don't aim to we don't go for for founder guarantees or personal guarantees or anything like that. We frequently don't even have financial covenants. So it is kind of it does have to be repaid. It's usually amortizing, and that does get repaid. But I think the perception that once you have debt, all of a sudden you can have everything taken away from you is maybe the challenge that we need to address, because that's not the case.
I think honestly, if I might add one thing, of course, it's also a situation where a lot of the VCs in CEE are awash in cash, right? So if it's a great company, you might want to deploy a bit more equity, additional dilution, versus getting you guys in. If it's a mediocre company,
then you give us a call, right?
You're loyal to it, right? I mean, that's
he doesn't mean that.
Yeah.
Among friends, right?
No, but this is a challenge for us. I think certainly in the last 3 months, we've seen our pipeline kind of balloon a little bit, because a year ago, you sort of had equity raining down on everybody who had an idea. Today, it's not the case anymore. So, but this is the wrong time to look, right? It's better to get the debt before you kind of need it, rather than wait until the world changes, right? Raf, I know this is from a legal perspective. This isn't sort of really, but maybe you have some observations or comments as well before we move on to the next kind of part.
Absolutely. I mean, I fully agree with what Tomek and Michael said, and from my discussions with the founders, there is very little awareness of how venture debt works, and I think it's just as a process that we're starting, especially when I look at Poland and Polish ecosystem. A few years ago, everyone was learning venture capital as well, the standards, how deal works, and what are the different structures of the deal, and kind of mechanics applied in the investment agreement. And the same way, I think founders have to learn how venture debt works. And obviously, Polish kind of legal structures are not too flexible, and they do not really kind of work that well with typical and standard venture debt terms. That's why perhaps might be one of the reasons that it's not that popular. But of course, when you look at the whole ecosystem as such in Poland, I think we started being at the stage where we have more growth rounds, more companies that are actually able to accommodate venture debt and become more interesting for venture debt funds. So it was kind of a vicious circle, I would say. So there were no venture funds available, there were no companies at that growth stage, and there was no awareness. And I think we are just entering this stage. And as you said, your pipeline is ballooning, and we had this great opportunity working with you on Omnipack's deal with Tomek. And I think, as Tomek said, like, he already got questions. I also got questions from the founders, how it works. So there is more and more interest, and I think it will be a natural process in Poland that it will become more popular. Plus, one more point that I wanted to add about this awareness. I think that in Poland and CEE in general, the aversion to debt is something also quite blocking, I would say, and a perception that venture debt is more expensive than equity is also something that is kind of stopping it from growing. And it's actually, when you look at it from a perspective of an exit, I mean, it's cheaper. It's much cheaper than equity, and founders have to understand it. But obviously on the short term, it might be expensive because of the interest and everything. But on the long run, we have to look at it from that perspective.
For sure. So it's an ongoing education.
Absolutely. Absolutely. And also, it's when we look at just purely the legals, most of the companies in Poland are established as limited liability companies, which is a structure that is not too flexible in terms of adjusting to typical venture debt structure with this warrant ticker. Or, for example, in Poland, we have a capped legal limit on the interest rates that can be applied, which is usually below the standard interest rates applied to venture debt. So these are the things that might be also impacting venture debt in Poland in particular.
Yeah. Well, I think this is again a segue into the next point, which is kind of what stands in the way. What are the challenges of putting venture debt in place? I mean, we've certainly come across, and Michael, your point earlier is correct. Every country has its own legal system. Switzerland, Austria, we've all sort of encountered various idiosyncrasies within those systems. So maybe starting with you, clearly, some countries or some regions have a better setup or easier setup, I would say, for venture debt. How do you see that? And does that ever feed into the thinking of founders about whether where to actually incorporate their head office, for example? I mean, I guess the venture debt wouldn't be a driver, but at the same time, if you look down the road, some jurisdictions are easier than others for venture debt.
So the question goes to Rafał or Michael?
I was thinking Michael would have a good first crack, but Tomek, you can go if you want.
No, so I mean, I would say definitely what already Raf mentioned, the legal framework was the biggest obstacle for us. The good news is we already did the heavy lifting with Raf's company. So that's, I mean, there is already a template to work on, right? But it actually took quite a lot of effort to figure this out. Exactly those topics that Raf has mentioned. So the warrants, some other minor issues. So I mean, the market wasn't ready for that. So the legal framework wasn't ready for that. So the contract is not like a typical, few pages. It's really long. So yeah, from my perspective, that was really the biggest obstacle, because other than that, the process is actually quite smooth.
But the good news is, if I may chip in, so that we don't sound too kind of skeptical, it's that with a little bit of creativity and hard work with both teams, it's doable. It was doable, and we did it. So obviously, it's not something that will entirely block the ability of Polish founders, especially Polish founders, to receive venture debt, no matter what the legal structure they have in Poland. So obviously, it's much easier if the company is incorporated in the States, because then the documentation is quite standard as in most cases in US deals. But we did the heavy lifting, and obviously we're very happy to discuss from legal side, you from your venture debt team side, and Tomek with founders side, how it works, and that it's absolutely feasible.
Michael, what do you think? What are the biggest sort of issues that prevent us from participating in the other 75%?
I think in the end, if you want to do it, you can do it. It's not a big issue, right? It's just founders have more options these days, right? If you compare revenue-based financing, in some cases this is much easier for a good set of companies, and it's broadening, and you don't need to work on a complex legal documentation. It's much easier to integrate, and I think that is going to get even more easy, tying into revenue streams and stuff. There's a set of companies for which is not possible. I do think all of these problems are not specific to venture debt. There's more specific to sort of startup funding in general. I just think in the geographies I know, the legal framework in general for companies and company law is not built around high growth companies that basically operate on very low revenues compared to their financing structure. I think that's the problem. And then adding that to that mix is usually sort of on the accounting side, and then the legal that follows is sort of tougher. So I think you need a set of professionals around the table that just know what the implications are. And very often we have like scenarios where then you have a couple of angels in the mix that have never done this before, and they're scared that whatever is going to happen. Or you have that doesn't want to take the risk and explain to the authorities that yes, that accounting or that balance sheet is going to show a loss carried forward for the next 20 years or something. So it's more these. I don't think it's really there's nothing in the legal framework that prohibits it, but it's kind of like it adds orange flags, and then I feel any deal, like if there's too many orange flags for the one who decides it, adding up, then at some point
it becomes too hard. Yeah.
But I agree with what Raf said. I think it's a learning process. 5 years ago, 10 years ago, people wondering what is a convertible note, how does a safe work, and nowadays this is like standardized and everyone knows how this works. And the same is going to be for venture debt. And then the question to me is much more interesting. I mean, I've seen also venture debt providers go much earlier to sort of seed stage companies, which is an interesting move. I've seen term sheets being issued even out of a round with sort of a prospective round happening. So I've seen venture debt providers become much more flexible, which is great. But that also means it's interesting now how that will fit into the funding mix for a company overall.
Yeah, I mean, I think at this stage there's such a range of sort of different companies that there isn't, unlike sort of traditional private debt or public debt, which is you're dealing with audited companies. It's very easy to credit assess. Here you're really being creative, and the jurisdictions are different, and the framework isn't necessarily set up yet. So you do have to be creative, not only as a venture debt provider, but also as a lawyer or as a service provider. So, but the good thing is that it does allow for creativity, so you can do some interesting things. And that's, I think we try to be good at that. Okay, so I think we've got to wrap it up soon. Just as the last question to each of you, what advice would you have, or feedback, advice for Flashpoint? How can we get better? And from your experience, or maybe from just observation, in terms of venture debt. I mean, the VC guys can get their own advice elsewhere. Me and Donatella.
I mean, from my perspective, you're already doing a great job, I would say. You're raising awareness of venture debt and its availability. You made it available. Everyone knows about the round you did in Tomek's company. So that's already great. And I think that apart from obviously your deal making, the educational part is very important, as we all said. It's all about education. So I think you're on the right track. So my advice would be to keep it up in this way.
No, absolutely, and I think education is critical. So maybe even an idea, maybe like a white paper, or maybe a term sheet template. So I think for equity, some top tier funds, they're actually sharing their term sheet template to say, listen, that's what's the standard, so that's what you should be expecting from the others. I think that would help a lot. And then you could even proactively explain some of the topics that are not so obvious. So that's that. But then I think it's really, keeping it simple is critical. And by the way, that's one of the reasons why we've decided to work with you guys is exactly the simplicity. So no super sophisticated sort of covenants or terms.
Yeah.
The second piece of advice is, guys, you should definitely showcase your team. So I had a pleasure to work with Donatella on this one, and Michał, and that was also a big argument, right? So Michał is a person on the ground here, so a Polish team member. So that was super helpful. We really had a great discussion, productive discussions, and he's really super helpful now. And then Donatella, I mean, we saw how dedicated she was, how full of energy, and again, that really pays off. So I think these are your strengths, so worth just showcasing.
Thank you, guys.
Agree. Just one more idea. I think transparency is also key. As much as VCs have become more transparent over time, clearly stating what they need, what they look for, it's almost like if you could put that out there and make it very clear when's venture debt the right thing to add to your mix, because founders still struggle to understand, when do I use that? What's the right stage? When is it valuable to use that? That would help them a lot, and would help us in the argumentation, because we're often bringing it up, and then founders are very hesitant about it. So the more transparency, the better.
Sounds good, guys. I mean, I have to say that all makes good sense. We'll do our best to keep improving. Okay. Well, look, thank you very much for joining this panel. It's a great pleasure to see you virtually. Hopefully we can do this in physical form. maybe next year or even before that. Thank you again for coming on the panel, guys.
Thank you.
Thanks a lot.